Hey everyone, I want to give a quick shout out to this episode's sponsor, Copper. Copper is an institutional custodian in crypto and provider of prime services. They're also one of my favorite companies in the space, so thank you very much to Copper for making this episode possible. You're going to be hearing all about them later in the show. Hey everyone, welcome back to another weekly Roundup edition of On the Margin. Today I'm joined, as always, by my magnanimous co-host, Mr. Mark Uscale. Mark, how are you?
Magnanimous. I'm not sure I can come up with why magnanimous today, but it's been kind of a crazy week. Maybe you know what, magnanimous might be that I did take full credit for the pump this week in Bitcoin because I pulled out the green pants last week, and we kind of predicted that it'd be a pretty good week, which it has. So lots to talk about. I do have a little glint of green for the candle there, but orange is Bitcoin Friday. And I know I still have not received from my friends at Mount Socks, which I guess they're not listening to me, my 2024 halving socks, which I really need, because it is all about the halving, right? It's, we had the demand shock, price went up. Now we got the supply shock coming. And the supply shock, it's actually big, because I don't know if you guys put out the data, somebody put out the data, 69%, maybe it was a lie, 69% of a BTC hasn't moved in the last 12 months.
It's a huge percentage. I'm not sure what it is off the top of my head, but I'm actually just looking for the flows data that's been coming in this week, because it's been a massive week for inflows. And you and I have been talking about this on the Roundup for the last couple of weeks, but the GBTC outflows have basically they've started to peter off. They had a little bit of an upsurge this week, but they're down in the $50 to $100 million range. And it's really beginning to pick up with gusto from IBIT and FBTC, which are the iShares, and Fidelity. Even Bitwise, shout out Bitwise. They had an over $100 million inflow day yesterday. So here are the total numbers. We've had about 4.5 billion in net inflows this year. That's against almost 7 billion, 6.8 billion in GBTC outflows. So yeah, it's been over 11 billion in total inflows, 4.5 net. And yeah, the price of Bitcoin is responding. It's just been kind of a one-way walk up. And we've got our halving coming in April. So how big of an impact do you see that the halving having here, or is it basically just the ETF, the Bitcoin ETF flows in the driver's seat?
Well, it's the combination. I mean, we had an aggregate demand shift that's only going to accelerate, right? The increasing demand for ETFs is it's not going to be linear. It's going to be exponential. Now, it'll take a while to get to the knee of the curve, but as people like Vanguard and UBS and Merrill Lynch eventually drop their prohibitions against the ETFs, more capital will flow. But even with the largest firms still adamantly against, you've seen individuals and institutions. A big chunk of the BlackRock capital is coming from big places, sovereign wealth funds, pension funds. So that demand shock isn't going away. And there's 900 BTC a day produced today on April 8th. I think it's interesting that now the estimates are that the halving is going to occur on the same day as the solar eclipse, which is kind of wild. When it was going to be 420, everyone was all excited, and I think it's going to be 4.8 now. It looks like the number, but we don't know for certain. But if it does coincide with the solar eclipse, I think that's kind of wild. But that demand is challenged because this huge amount of coins, you got 1 million from Satoshi, whoever, and then you got estimates somewhere between 3.5 and 5 million coins that are lost or stolen, multi-sig, that are stranded, whatever. So you're talking, and then you got what was the number? Like 10 million held by individuals, most of them hodlers who have said, can pry it from my cold, dead fingers. But ultimately, the way markets work, I was busting a little bit on Scott Melker the other day. He's like, oh, there's, more buyers than sellers. I'm like, no. There's always exactly the same number of buyers and sellers. Right? That's just the nature of markets. But the price changes. And, someone says, I will never sell. There's a price at which you'll sell some. I mean, maybe not a lot, but if price gets high enough, you'll sell. And that's how markets move. So the supply shock, though, we go from 900 to 450 a day. That's a big deal if that hodler group or hodler group, however you want to pronounce it, won't give up their coins, and there's less coins for the miners to sell. The other problem is the miners haven't been selling all of their coins. Some of them have, but some of them have been hoarding a little bit. So the supply problem is real, and it's only going to get more acute.
Hey everyone, wanted to give a quick shout out to this episode's sponsor, Copper. Copper is an institutional custodian and provider of prime services within digital assets. Today, what I want to talk to you specifically about is Clearloop. Clearloop is a solution from Copper, which to me solves one of the biggest problems for market makers, high frequency traders, hedge funds within digital assets. You know the exquisite pain of what I call the pre-funding problem. So if you want to take advantage of arbitrages that pop up across different exchanges, or you just have a trading strategy which requires you to be active on multiple different centralized exchanges, you have to pre-fund your account at each one of those exchanges. Now, this is not ideal for a whole bunch of reasons. One, you have to take counterparty risk from those exchanges, which, as we saw this last year, can have major consequences. Two, it's capital inefficient. You have a whole bunch of assets spread out. Most of them are not doing anything most of the time. And three, it's just not great from a workflow standpoint, and it creates administrative overhead. So enter Clearloop. Clearloop is the secure MPC custody solution provided by Copper. The way that it works is you deposit your assets into this MPC solution, which is owned and operated by you. Clearloop syncs up with a whole bunch of your favorite exchanges, and then you can trade securely from Clearloop itself while not taking any counterparty exchange risk with any of these exchanges. And it's a super easy and nice UX. Now, Clearloop is trusted by the likes of Flow Traders, Brevin Howard, Nickel, some of the best in the business. But the coup de grace is, in the extreme edge case that one of these exchanges were to go bankrupt, they have a very clever trust structure which segregates your assets and keeps you completely protected. So click the link at the bottom of this episode, especially if you're a hedge fund and market maker and you want to learn more, or better yet, Dimitri, the CEO, is actually going to be in person on a panel hosted by yours truly at Digital Asset Summit. So DAS London, that's March 18th to the 20th in London. So you should definitely click the link at the bottom of this episode, give your boy some credit, but also, even better, come to DAS London and hear from Dimitri himself. All right, cheers everyone. What do you think about the Ethereum ETF? So that is sort of the next thing on the horizon here. And yeah, I know the Bitcoin ETF just happened. It was a mini buy the rumor, sell the news. I think Dan Morehead is going to be proven right that it was a buy the rumor, buy the news event, as we're well above the highs, even on the run up on the day of the ETF going live, or the ETF complex going live. And now people are starting to wonder what's going to happen with Ethereum. So there's a date upcoming in May, which I think is the last date for the VanEck spot ETH ETF approval. There is a question about whether or not they can include yields, like some form of staking in the ETF, which feels unrealistic for the time being, but maybe in the future. What do you think about this idea of the ETH ETF in general?
I mean, well, there's the logic, and then there's the emotion. So the logic would say, hey, SEC, you ruled multiple times that Bitcoin and ETH were not securities. Therefore, if you approve the Bitcoin ETF, ipso facto, or ceteris paribus, you should, approve the ETH ETF. That said, I watched, GG on the tube the other day, and I would say logic has nothing to do with this. He was all emotion, and ain't no way that guy. And he basically kind of snapped at the interviewer, and it was pretty ugly. And he basically said that's a decision for a 5-member committee. And I think if you think back to the Bitcoin ETF, it was only a 3-2 vote. And he was the deciding vote, but he was forced, like literally forced by the courts, in his mind, and action, probably in actuality.
Actually, I think, yeah.
Yeah. So I think actuality, but I think highly unlikely it gets approved would be my guess, that emotion trumps logic.
Yeah. Do you think, I mean, even this, I mean, one thing that we've seen from crypto over and over is that this dangling of the meat, right, in front of the market is that actually ends up being a massive driver of price action, because the idea is, well, the market saw what happened when we got a Bitcoin spot ETF. Eventually, we're going to get an ETH spot ETF, and maybe there could be some attempt to front run that. And probably we saw that with the Bitcoin ETF, right? From the period of June or July of this year up till it was finally approved or June and July of last year up till it was approved in January. So do you think there could be a similar effect for ETH?
It's tougher to tell because all things are not equal. So one of the things that always happens in this part of the cycle. So we're in the late stages of crypto summer. So June we swap over into crypto fall and get the parabolic part. In that late stages, you see this kind of price action where Bitcoin becomes the lead because people are anticipating the halving. And then the others, particularly ETH, they tend to move in lockstep, like at a ratio. At one point it was like 10-1 or 8-1. And they literally just move in lockstep. And then it filters down into the other coins too. And some of them actually then get on people's radar, and then they actually have their little spiky moves. And you saw that with Doge and Shiba in the last cycle, not so much this cycle, but at least people aren't talking about them as much. I don't see that silly little dog all the time. But I think this time it's frogs and other things. But I think in Bitcoin's case, and I haven't proven this in the sense of going to the wallets, but I shouldn't say. I've seen the wallets that were accumulating Bitcoin in advance of the Bitcoin ETF approval.
Mm.
I will argue those were related to BlackRock et al., that they were basically accumulating some that they could then go buy from and make a little profit too. And maybe it was friends of the firm. Maybe it was hedge funds that they work with. Maybe it was, I haven't done the forensics to find out who, but my guess is that was pretty, you saw it every day. And that was front running of a different kind. Like normally front running is, hey, I just want to get in because I know something's going to happen, like an earnings announcement, like Coinbase, which we'll talk about. So there was a lot of front running going on because there were people who were pretty sure this was going to be a blowout number. And you saw it was going up every day into the earnings and then ended up even more after the earnings. But that's a different kind of front running than this. This, I believe, was getting supply because when the demand for the ETFs came in, I think people knew it was going to be hard to go find enough Bitcoin to buy. And so that could be what's happening with ETH. So if people were doing the same kind of thing, then you'd have upward pressure. And you've seen ETH actually outperforming modestly. I mean, it's been pretty neck and neck, but outperforming modestly in the last few weeks. I probably lean that unlike the Bitcoin ETF, where you had pretty clear signaling by the sponsors that, yeah, we're good. And, the relentless meetings back and forth. I don't hear about lots of meetings and lawyers doing lots of billable hours on ETH. So
Yeah, I agree with that. One interesting tidbit, we had David Troy on the interview portion of this week, and he was really deep in the GBTC trade, or basically the grayscale trade, which was the arbitrage where you could buy in at net asset value. GBTC was trading at a premium, so after a year, you could exit at the market rate and collect, at one point, which is 60% premium or something like that. ETH, so that was the Ethereum trust from Grayscale. So he actually mentioned that at one point they shortened that window from 12 months to 6 months. And that was a huge part of the, after you lower the length of the lockup, it becomes much more attractive from a risk reward standpoint to run that same arbitrage. And so that ended up driving a lot of the ETH price action that we saw in later 2021 into 22. And it's just funny. It's just a reminder that oftentimes what's driving price is invisible to people at the time. People ascribe narrative to it when really there's something kind of mechanical going on behind the
yeah,
scenes a lot of the time.
yeah. Ex post, it's easy to make up a story, but you don't know in real time. Sometimes you do, but not necessarily.
Yeah. So why don't we switch to talking about Coinbase earnings? This was a fun one because everyone's favorite crypto company had a huge beat this last quarter. I do think it's funny. I actually went back and looked. The Bank of America, even 2 months ago, they got turned more bullish on Coinbase and they upped their price target for the coin shares from $60 to $66. Now coin is trading. I don't even know what it is pre-market, but anyway, they had a massive
It
earnings
was like
beat. They're trading.
160, but it might even be higher. I don't know.
I think it's higher. I think it's closer to 180 now. Here, let's see where it is pre-market. Yeah,
Whew,
190. 190
190.
pre-market. Yeah.
190.
So yeah, jumped 15% after these earnings. And the reason why, so we're, for those of you who are following along via video here we can zoom in a little bit. You can see that Coinbase they ended the year very strong, actually. In terms of net revenue for the entire year, they did just under 3 billion, 2.9 billion, which was just a little bit shy of the 3.1 that they did in 22, which, if you know how bear markets were, I mean, that's pretty incredible that they managed to do that. The big difference was the net income. So they lost 2.6 billion in 2022, and they turned a profit of 95 million in 2023. So just a massive reduction across the board on OPEX. And again, for 22, they lost 371 million in EBITDA, or they had negative 371 million in EBITDA. And for 2023, they did 964 million in EBITDA. So Q4 was great as well. They grew net revenue from quarter over quarter from 623 to 905. They generated a massive gain in their net income as opposed to a loss. And yeah, I mean, I feel like that's the major story across the board. I guess the only other thing that I would point out is people are very excited that transaction revenue has rebounded really strongly. It's rebounded more on the consumer side of things than the institutional side of things. People are very paying a lot of attention to when retail is going to come back to this market. So that's worth calling out. And this subscription and services bucket of revenue, which is really critical for how Wall Street views them, because they think that fee compression is going to happen over time, continues to just chug along. They grew, something like 20% quarter over quarter from 334 million to 375. But Mark, what did you think about this earnings release?
I mean, like I said, it was a blowout, and I think it was the most unexpected, or maybe the most unexpected expected outcome, in the sense that I think a lot of people thought, okay, they survived, and it's no longer just a shitcoin casino. And hey, wait a second, seven, or maybe I think it was 7 of the newborn 9, we're going to custody with them. And hey, wait a minute, they're making a lot of fee revenue. It's kind of like when Wells Fargo many, many years ago separated from the other banks. And all the banking is a net interest margin business, right? You pay your depositors X, you lend it Y, and you earn a spread. And Wells Fargo kind of changed it up and said, well, but we're gonna tack on some fees, and we're gonna charge some. And that's when Buffett bought in, and that was his whole thing, is he wanted them to pay him, nice dividends so that he could lever up. That's his plan. He takes low volatility assets and levers them up and never pays taxes. It's genius. And so I think that's kind of what's happening here in that when they started, it was all about activity and volume and getting as many things listed and getting a lot of trading and making your commissions. Well, now they have things like, massive custody books and huge institutional business of, cold storage. I thought about wearing the cold storage socks today because, that's one of the challenges for the ETFs is so much of Bitcoin is sitting in cold storage, not actively available on exchange. That it's going to be tough for them to find enough to buy. And, we own a lot of Bitcoin across our funds, but we don't keep it on a ledger, even though we love Ledger and that's a portfolio company. It's in, Coinbase Institutional's kind of what was their Zappo business that they bought.
Yeah. How much of a revenue driver do you see? This was a topic of interest in the analyst questions, but how much of a revenue driver do you see the custodial business for ETFs being moving forward? And there are other ways that you can, like, there's a way that Prime monetizes the ETFs, and what do you think? How much of a revenue driver are the ETFs?
I think it's going to be a very meaningful driver. It was just getting started now. But over time, investment banking, which I always thought was an interesting term because really it was the trading components of people like Goldman Sachs and others and their prime brokerage units that made incredible amounts of money doing things like stock loan and extending margin. So there's lots of related businesses that if you are essentially the financial institution for the digital age, which is kind of what Coinbase has established themselves as, there are many ways they can augment just the commissions and fees from trading and activity. And I think custody will continue to be an increase. Now, custody itself is not a high, it's not really a high margin business, and they do compete on price, but you make it up on volume, right? And it's scale. There are benefits to scale in these businesses, and scale comes from trust and from reputation. And I think they are the dominant brand in the business. So that bodes well for the future.
I agree. What do you think about this bucket of subscription outside of their transaction revenue, which I do think that Wall Street is going to continue to underestimate the transaction revenue. Just a prediction, and just to take a minor.
Well, you've broken that down every quarter. For the last year or so, you've talked about that and been dead right on it. And I think the average person, look, part of the challenge of the investment industry, analysts, they're only right about 40% of the time, which is a crazy stat, right? Wall Street analysts are right about 40% of the time. And yet they still, seven-figure gig if you can get a job. And so, and the game of catch up is extraordinary. You always see the bank after the stock price goes up adjusting their, earning or their price forecast, or, but to have like you said here, a price target of $66 for a stock that's trading at 190. That's a total head scratcher. And I think it's because they don't understand the business. Maybe they don't want to understand. That's part of it. There's pressure. I'm sure some people remember the story of the kid that wrote the negative article on Trump's casinos, and he got him fired, and he got reinstated and paid, and because it turns out truth is supposed to be an absolute defense, and they eventually went bankrupt. But it's a hard world. Wall Street is a tough world in the sense of it's not always just, hey, let's put the truth out there and let the people decide. It's who pays what fees, and which deals are hot, and which people know kind of the path to navigate to get kind of the front row, or the first the best people on their tombstone. So it's complicated.
Yeah.
But I would say
And
that this company has been unfairly punished by lack of coverage and lack of qualified people. And that doesn't mean everybody who's following it isn't good, but I have yet to see anybody do as good a work as you've done on this. Just in the
I appreciate it. It's just accounting correctly for the reflexivity of the business model, which is extreme. And I think it probably there were some crypto natives that missed it on the way down, but I think people aren't going to be totally prepared for what these volumes and the fees that they generate are ultimately going to end up doing on the way back up. And the nice thing about Coinbase's business model is that they've built this nice other part of their business, which now makes up a very solid chunk of their revenue, which is subscription and services. So it's this combination of stablecoin revenue, blockchain rewards, interest income, custodial fee revenue, and this sort of other subscription and services revenue. I'm actually a subscriber. They've got Coinbase One in there. I'm a subscriber to that, which I said I wouldn't be, but I am. I actually find it pretty useful. And yeah, they have like a great staking business, which is their blockchain rewards business. It's going to be really difficult for uh, people to value or totally grok because there are no company public staking companies, so people don't even have a framework for how to value that. Interest income and custodial fee revenue people get, but the stablecoin revenue is interesting because it's doing 170 and change per quarter of revenue, but it's also pretty countercyclical. Like this is the thing that sort of expanded during the bear market. So not only do they have this great reflexive transactions business, but they've built something that feels much more like a steady, almost in some senses countercyclical portion of
yeah.
their revenue.
Yep.
Which is really nice. So,
Yep.
and the last thing that I'll mention on this, which I found pretty interesting, was I was listening to these analyst questions, and they were saying some things. It was just like, "Hey, we're assuming that we're going into a bull cycle. So, how do you think about this?" Or actually, there was one question from an analyst, which they were looking at their sales and marketing expense, and he started to question it. And my assumption is, oh, this guy's going to ask, why is Coinbase spending so much? And what he actually asked was, "Hey, we're going into a expansion cycle. Why aren't you spending more?" I was like, "Wow, that's pretty interesting to hear from from these analysts." So I thought that was an interesting tidbit from the Q&A.
Absolutely.
Yeah. Maybe one more story here before we start to wind down. But there was an interesting headline from, I think CoinDesk wrote this week, that one of the Federal Reserve governors was open to questioning the idea that stablecoins are actually beneficial for the U.S. dollar. So I don't know if you've seen this. This is a long. I'm like Nick Carter has probably done the best job of advocating for this view. This would be my view, but the idea is, to maybe set a little bit of historical context, stablecoins are one of the areas that regulators are watching most closely and perhaps most uncomfortable with. You could look at a stablecoin as something similar to the construction of a money market fund, where you have depositors and then some sort of asset that's supposed to track the value of a dollar. The other way that you could look at it is, hey, there's this alternative financial system, and they have, without any prompting from the United States, actually a lot of the opposite of prompting. They're disincentivizing, but they're adopting U.S. currency within this ecosystem. And actually, this is a driver for this is people that will buy up U.S. debt. This is a way to expand dollar hedge money, and it seems like the Federal Reserve, or at least some of the governors, are open to that point of view. What do you think about that?
I think it's making lemonade out of lemons, kind of, in the sense that the initial stiffening and negative reaction, totally logical. If you think about if you're draining dollars, fiat, out of the traditional banking system and putting them into this alternative financial system, that gets ugly really fast because of the leverage in the traditional banking system. That's why I said in the First, they ignore you, right? Playing with your magic internet money, whatever, go away. Then they kind of laugh at you. Oh, look how cute. $10 billion. Wow. $100 billion. Now we got a freaking problem. And that's where kind of we are is the problem phase, which was then they fight you from 2 years ago. Like, whoa. People are taking their money out of JP Morgan or Bank of America and they're sending it to BlockFi or Voyager or Celsius or whatever, converting to stable coins, and they're getting paid interest in a zero interest world. That's a problem so the banks were like, hey, you fix that. And Ms. Yellen was like, hey, we need to regulate stable coins and we need to ban them and Tether's a fraud and all that stuff. Well, now you got at least a few people saying, well, whoa, hold on. Yes, it's a problem that there's leakage from the banking system, but ultimately the potential that all of those assets are ending up in dollars or treasuries, like that's actually potentially a really good thing. Now, I do think the bigger question for me is how long do stable coins utilize that collateral as opposed to some other collateral as the quote unquote risk-free or stable asset. But it's hard to you have the algorithmic stable coins, which were never stable and blew up the industry. So you can't use like an 80 vol asset like Bitcoin as the base layer. But I do think there are some other things that people could think about utilizing, hard assets or other currencies for that matter. But I think it's the right approach. The short, I should have said, just giving you the short answer. I think it's the right approach to say, hey, this is a benefit to us because we do have the risk-free asset, which is the treasury rate. And if they're going to accumulate lots of treasuries, that works for us. But I get why the banks still don't like it.
Hey everyone, we'll be back to the program in just a moment. But before we return, wanted to let you know about DAS London. DAS London is the largest institutionally focused conference in crypto hosted by Blockworks. But I wanted to give you an update because we are now 10 times oversubscribed for this conference. So the bad news is we have actually got to lower, as much as I love you guys, the listeners, we've got to lower our discount rate to margin 10. That's going to get you 10% off. I would highly recommend that you do that soon because you might have noticed ticket prices have gone up 200 pounds and they're only going up from here. And I actually can't guarantee that we're going to have this discount rate forever. Since we last talked, we've had a whole bunch of new great speakers sign up for the conference. We've got Brad Garlinghouse as a keynote. We've got Pascal Gauthier as a keynote. We've got new speakers signed on from Goldman Sachs, from Franklin Templeton, from some of the largest family offices and allocators based out of Europe. So Theta Capital Management, L1 Digital. And actually on day one of the conference, we're going to be having an investor day, which is a Chatham House rules hosted by some of the largest investors in crypto. Then the other thing that happened is we've got our VIP tickets that just went live. There are only 60, but we've actually had a bunch of them that just sold out even in one day. So if you want to be a VIP at the conference, make sure you get your ticket. And again, use code MARGIN10 to hang out with me and Mark March 18th to the 20th in sunny London. Cheers. This is Jim Bianco's point as well, where regulators are concerned about fiat-backed stablecoins, which is, again, if your mental framework for looking at stablecoin is that this looks like a money market fund, sometimes there are runs on money market funds. Famously, this happened in 2008. And I think what they might be concerned about is that, hey, if there's, there's 100 billion, 150 billion today sitting in, across Tether and USDC. What if in the future there's $1 trillion sitting in USDC and this is magic internet money and not real? So what if all these people decide to run and then there's a, fire sale of treasuries on the other side of that? I think that is a concern of theirs. And I think another thing that they'd be worried about is, the dollar is an export of the US. We we have a lot of control over dollars that are based in the US, but there are actually other dollar systems as well, like the euro dollar market, which is actually much larger. And we actually do feel the need to come in and bail out the euro dollar market when shit goes sideways. And I think maybe their concern is that, hey, maybe this is another large, less regulated kind of offshore dollar market that we might have to come in and bail out if stuff goes sideways. So maybe that's another concern on the longer term time horizon. Yeah. And then finally, one more story before we wind down. But CPI came in a little bit hot this week, and people were concerned about it. It was like 0.1% month over month more than everyone thought it was going to be, and market kind of sold off and then aggressively rebounded. So non-issue from your standpoint. Yellen came out and said we should not zone into, we shouldn't overcount single data points. So it doesn't seem like she's concerned. But what do you think?
The narrative shifts to whatever's convenient, right? When the number was in their favor, right? It was always about single data points. Oh, look how great the number is. And now that the number was a little different, when it was going down, they're like, oh, every data point is important. It's like the most important data point. Like, stop. The trend is maybe important, but the data point's not important. So, the narrative will be what the narrative is. Like I said, the narrative is always created after the fact. And that's stale data anyway. And it's not very accurate. You got the I don't know what they call it, Trueflation and a bunch of others that actually, or the MIT inflation project, that are actually calculating probably better indicators of inflation. And those all have different values. At the end of the day, 3.1 or 3.2, that just doesn't matter. There's not that level of accuracy, and there's lags, and so but I do expect the government to say whatever is useful to keep things afloat. We are in a speculative bubble in the stock market like we've only seen one or two times in history. And we're like, no, we're not. And NVIDIA is not Cisco. I'm like, well, it kind of is. And you can find differences, but you look at the paths; they're very similar. And I showed the chart of this yesterday in my Around the World thing. That we've seen this movie before. In 2000, we had this company called MicroStrategy, and it went from $1, literally parabolic, to $300. Everybody was short. The shorts got carried out. And then eventually it completed the parabola and went down 99%. And Michael got in trouble and all kinds of stuff. Now we have this super microcomputer Inc. And it's like tripled in 4 days, and it's gone totally parabolic. And that's a bubble. We're in a bubble, but that's what the government wants. The government wants a bubble because the boomers own a lot of stocks in their 401ks, and they don't have enough to retire. So we need to inflate those assets. So it shouldn't surprise anybody that we're going to keep saying all is well, and just, keep buying your houses and keep buying your stocks and keep the economy, for lack of a better term, high, because there. You can say all you want, but there are no examples, by the way, none, zero. Jeremy Grantham's got great work on this. There are no examples of these types of parabolic moves up that then go flat and stay flat at the top. They just don't exist. Now, they can go longer and higher than you think, but they don't make flat tops. They make, Eiffel Tower patterns like this one.
Yeah. So for folks who are following along via video, we're showing a chart of Cisco from 1996 to 2000, looks like 2003, overlaid with NVIDIA from 2020 to the present day. And, these are all of these charts, I'll just say as a disclaimer, they're never very scientific, and you shouldn't look at that as being you shouldn't look at these charts and say this is exactly what's going to happen. But
No,
to your
no,
point, nothing is
no,
parabolic forever. Yeah.
no. I mean,
So
there are zero examples of parabolic and flat, and it doesn't mean it can go much further than you think. And I learned the hard way, by losing money, which is the way you always learn in this business. You can't short them. And that's why they do this, right? Is people are trying to short Supermicro and NVIDIA, and you get cooked. Now, when they finally roll over, then there's very little that stops them on the way down. And then you get back to a fair value. And look, I just keep coming back to Scott McNally, right? And in 2000, when Sun Microsystems did one of these, and he was selling it 10 times revenues, right? Not NVIDIA's 40 times revenues, 40 times revenues, or what's the next? There's another one's at 13 times revenues, and then Amazon's at 10 and 9, or Microsoft's at 13. He said at 10 times revenues, to make a decent return over the next decade, I basically have to give you all of my revenues as a dividend, which is illegal, and I'll go to jail. So that's not going to happen. His stock went down 98% over the next decade. So people didn't make a good return. And I'm not saying that will necessarily happen, but it will. And I can't tell you when, but trees don't grow to the sky, and competition is real. People forget, NVIDIA didn't exist as a business for a long time, and we made lots of chips, and Intel did that. I mean, Intel had a 20x move in 2000, 2001. No, 99, 2000, sorry. And, it was going to be the future of AI and all this stuff, but then it went down, and it's now lower today, 24 years later, than it was back then. Same thing with Cisco, because other companies get created, and this GPU craze is real. I mean, it's real. But it's going to get replaced at some point by something else. Will we have ASICs, or will we have 3PUs, or will we have, I'm literally going to go, have lunch with one of our portfolio company CEOs that runs a business that they have a chip design that they think could replace many of these super chips that NVIDIA and others are producing. Well, we'll see.
yeah.
But anyway, that's the way it works. So that's actually a pretty good segue for my kind of reveal. So I run venture fund, and a year ago you came to me and said, "Hey, think about doing this thing, a roundup of my weekly show on the margin. We do it once a week." I don't know if I can. I don't know if I can commit to once a week, but we'll try it. And we did, and we tried it, and we did it for a year, and it's been great, and it's been the best hour of my week. But I think it's probably time I not do it. And that's sad for me to say, and not where I really want to go. But I have my own around the world with USCO that I've been doing, and that used to be a monthly cadence, and it's turned into a weekly cadence. And we have our digital currents, which again used to be a monthly cadence and is now gone to more frequent. So, and deal flow, best I've ever seen in my career. Just, it's an amazing, amazing time to be an investor in the digital asset ecosystem. And as much as I love doing this, I'm probably not being paid by my LPs to be a podcaster. So.
Yeah, Mark, it's like the most bittersweet news ever, because obviously I'm very sad, but I'm happy because these last year and a half have been, just a ton of fun doing this with you. And I know the market is picking back up, and your duties at Morgan Creek are pulling you back. And I'm happy for Morgan Creek, the fund, and I'm, bittersweet sad for On the Margin in our show. But I'm so proud of the work that we did together these last year and a half, and this has always been the best hour of my week. And obviously, I'm still going to be nagging at you all the time to come to our events and stuff like that. So yeah, this is not goodbye, but unfortunately, it is the end of our segment on the margin. And yeah, it has been one of the great experiences for me. So obviously not goodbye, but yeah, I'll be tuning in. I guess now I got to get my Mark Yusko from your own show. So I'll be tuning into that, and then yeah, we'll look forward to all the great things that happen at Morgan Creek for this year.
All right. Well, again, have enjoyed it, and wish you guys all the best at Blockworks, and we will certainly, our paths will cross many times, but I guess I'll have to do my sock reveal in some other virtual medium, but people probably
I'll be tuning in to see
anyway.
where the market is going from what socks you choose for the week.
Yeah. The sock of the week post. But
yeah.
All right. Well, again, best hour of my week.
Best hour of my week.
Talk to you soon.